This slideshow will take you through some of the main points of the new revenue recognition standard. And this revenue recognition standard has been in the works for quite some time. They first started talking about it in about 2006. The actual work on the accounting standard update really began in 2010. So now we're sitting here in 2013, and based on meetings that they've had, they expect this standard to be finalized by the end of this year. So they had meetings earlier in the summer, and so as of August 5th, they want this standard to be effective. Basically, what this means is every company that files financial statements as of January 1st, 2017 will have to follow this standard, and they're not allowing companies to early adopt this, so they have to wait until 2017. It says 12, 15, and 2016, but really companies don't really file mid-month, so really that means January 1st, 2017. So what the FASB is requiring is, as of January 1st, 2017, they'll have to start following the new revenue recognition standard, and based on the consistency principle, the FASB is also going to require companies to restate any financial statements that they present in a comparative financial statement. They will allow some exceptions if it's too much of a hardship to do that, and it's just too much in terms of data gathering. So remember that our current revenue recognition principle states that we recognize revenue when the earnings process is deemed to be complete, and we have reasonable assurance that we're going to collect on the asset, which is usually cash. So the new revenue recognition standard, the main principle says that we're going to recognize revenue when we've transferred the goods or services, and the revenue that's going to be recognized is the amount that reflects what we expect to be entitled to. So really, if you get down to it, there's no collectability issues here, and we'll talk about that in a second. So what you expect to be entitled to, that necessarily doesn't have to be associated with what you think you're going to collect. And this is a big change in this new revenue recognition standard. Basically, this standard has, based on the core principle, there's 5 key steps that they're saying that we need to follow in applying this principle. And for the most part, as you think about these, it's not really going to change the majority of the companies, but it does change the guidelines that they're having to follow. So the first one is identify the contract with the customer, and this can be either in an implicit or explicit contract. So what are each party agreeing to? So the second step is identify the separate performance obligations, and performance obligations are just really, what are we transferring? What are we exchanging for the consideration? Is it separate services? Is it separate products? So here, this is another big change. We're identifying these performance obligations. The third step is to determine the transaction price. In most cases, that's pretty straightforward. It's just the selling price, especially at a point of sale transaction. So there are some complications. Some transaction prices will depend on events in the future, and we'll talk about that in a second. So that's not that big of a change, but we'll talk about that. The fourth step is we're going to allocate, if we have separate performance obligations, we're going to allocate the transaction price, because the fifth step then is we're going to recognize revenue on each of those separate performance obligations as we satisfy this. So now think about this. It doesn't really change, for example, a retail company. So you go and purchase merchandise from a retail company. The contract is implicit. The performance obligation is the transfer of merchandise. The transaction price is basically set. Allocating the transaction price has already been done if you purchase different pieces of merchandise, and then you're going to recognize the revenue when you've when the obligation is satisfied, and that actually happens when you transfer the asset. So for some companies, this new revenue recognition principle really is going to change a big part of the way that they're doing things now. So let's go through each one of these steps. The first step is identify the contract, and based on the standard, the contract has to have all of the following characteristics. Commercial substance just means that when you enter into a contract, that contract has to have some future effect on both parties' cash flows. You're giving up an asset, in return you're getting cash if you're the seller. Approval just means that each party has approved it and they're committed to fulfilling their obligations. The contract has to state what each party is entitled to, and that's the rights of each party. Obviously the payment terms, how the consideration is going to be given, and performance. Performance not only means that each party is going to fulfill their obligations, but neither party can terminate the contract without some type of penalty. And again, these contracts can either be implicit or explicit. So step number 2 is identify the performance obligations. And sometimes the performance obligation, you're just going to have one, but this standard really sets out the rules for determining whether or not you have separate ones. And this is going to become important. So they say that a performance obligation is going to be a separate performance obligation if it's distinct. And it's only distinct if I meet two criteria here. The first one says capable of being distinct, and this just means, can I use it separately? Do I have the ability to pull it apart from everything else that I am transferring to the seller? Can I pull it apart and use it by itself? And then the second one is kind of related to that, but in the context of the contract, can that good or service be used independently of everything else in that contract? So if I have both of these conditions, then I have a distinct and separate performance obligation. So you notice in the text it goes through and identifies or gives us some examples of what we can identify as separate performance obligations. So we think about prepayments. Prepayments happen time-wise, they happen differently when we transfer the good or services, but this is not a separate performance obligation because what it says there, they don't transfer a good or service. Right of return is not a separate performance obligation, and that's actually an indication of a right of return, or when I have a right of return, it just means one party's failed to satisfy the obligation. Warranties, it depends. If it's an implicit warranty, like a quality assurance warranty, that's part of when I buy a product or have a service, then I am implicitly guaranteeing that it's going to do what I propose it to do. The other warranty, extended warranties, these are offered all the time. You go into Best Buy or to R.C. Willey or someplace like that, and they say, would you like to purchase an extended warranty on the product? And that is considered a separate performance obligation. And the other one, this is a big one because these are happening more and more often, but if you think about your frequent flyer miles, any type of loyalty card, these are options for the customer, and the customer doesn't necessarily have to take advantage of these, but they're options for additional goods or services. And this is a separate performance obligation where the revenue will be recognized differently from other performance obligations. So the third step is to determine the contract price, and basically the transaction price, which is the contract price. The transaction price is simple. If it's a fixed amount and I am going to pay it either today or in the near future, and in the near future just means I'm going to pay it within a year. So that's pretty simple if that happens, if it's fixed and I'm going to pay it in the near future. So the things that complicate this transaction price is what they call variable consideration. The transaction price could change depending on future events, depending on whether or not I fulfill a certain part of the contract. I may get paid more or I may get paid less, so they call that variable consideration, and we'll do an example here in a second. The other thing that complicates determining the transaction price is if the transaction price is actually either paid before, significantly before, significantly after. So before, 1 year before, more than 1 year before I actually transfer the asset, or 1 year after I transfer the asset, then I have to think about the use of the money. So I'm going to time value money just means there's interest expense or interest revenue associated with receiving the money too far beforehand or too long after I transfer the asset. And we'll look at some examples of that too. And then the other thing to consider, we mentioned that collectability is no longer a restriction on when I can recognize revenue. So the new revenue recognition standard handles the collectability of this transaction price a little bit differently, not too much, because you're still going to estimate the bad debts. The bad debt is no longer an operating expense. The bad debt is now going to be considered a contra revenue account, and we'll expand on that a little bit more. All right, so let's talk about each one of these difficulties by themselves. So when we talk about variable consideration again, some of the examples of variable consideration is discounts. I could have a rebate, some type of incentive, performance bonus if I reach a certain milestone, or if I reach a certain level of performance, then I get a bonus. But you notice that the variable, this is a base transaction price plus or minus something that depends on the future. So again, just to emphasize, the focus on this is not collectability. So even if there's a chance that I may not collect on this performance bonus, I'm still going to factor it into my transaction price. All right, so the transaction price is, if I have this variable consideration, is either going to be determined by a probability weighted amount, which just means the expected transaction price based on my estimate of the probability that the performance bonus or the performance will happen, or some event in the future is going to change the transaction price. And the other option is to use the most likely amount. So I can use either one to record the transaction price. So let's talk about each one of these and do an example of each one of these separately. And I guess before we do that, let's just remember that current GAAP, remember that part of recognizing revenue is I have to have reasonable assurance that I'm going to collect on this asset, and this is no longer a part of it. So I just have to have some probability that I will collect on these discounts or performance bonuses or whatever to record this. All right, so the variable consideration example, here we have a company, Thomas Consultants. They're providing some cost-saving initiatives to Brand Construction, and so they're coming in and providing a service. So the contract says that they will pay a flat rate of $50,000, and if they reach a pre-specified target, they'll receive an additional $20,000. If they reach this pre-specified target of cost savings. So if they provide Thomas or Brand Construction with these cost savings, Thomas Consultants will get a $20,000 bonus in essence. This is a performance bonus. So Thomas estimates that there is a 20% chance that they will achieve these cost-saving targets. So there's a 20% chance that they're going to receive the $20,000 performance bonus. So probability weighted just means we're going to do an expected value here. So we just look at the different outcomes. So we have two outcomes. Oops. We have two outcomes. So we have outcome one. The first outcome is that we do not reach those pre-specified targets and we receive $50,000, or Thomas Consultants does. The second outcome is that we receive the flat rate, of $50,000 plus we receive the performance bonus. So there is a 20% chance that we'll receive that bonus, which means that there is an 80% chance that we won't. And so the probability that we will get the bonus is 20%. So the expected values based on these probability weighted, and so I take 80% times 50,000, and there's an 80% chance that I'll receive 40,000, and there's a 20% chance that I'll receive 14,000. So the transaction price under probability weighted is actually going to be 54,000. So again, it's not based on collectability, it's based on the probability that these performance targets are going to be reached. So when I go to credit revenue for this transaction, I'll credit revenue for 54,000, whereas before under current GAAP, we would only be able to credit revenue for 50,000. So that's a bit of a change. So I debit the journal entry. Let's see if I can get the journal entry on here. The journal entry is going to be a debit to accounts receivable for 50,000, a debit to a bonus receivable for 4,000, and a credit to revenue for 54,000. Whereas before we would debit receivable and credit revenue for the same 50,000. So that's how that differs. The most likely amount, I just record the transaction price based on the most likely amount, and the most likely amount in this case, we have an 80% chance of receiving 50,000. So under the most likely amount, the transaction price will be 50,000. And here we'd have a debit to accounts receivable of 50,000 and a credit to revenue of 50,000. So pretty straightforward. The new revenue recognition again allows us to look into the future and consider those things that are based on some event happening in the future. All right, so let's talk about the time value of money and how significant prepayments or postpayments actually affect how I determine the contract price. So the time value of money, and the time value of money just merely means that there's a value to having the money over time. So if the payment is not within 1 year of satisfying that performance obligation, then there's two parts to the sales transaction. There's a delivery component, which is related to the value of the asset that you're transferring. And then there's a financing component. So if I have a customer who gives me a prepayment one year or more before I actually transfer the asset, we are considered, as a seller, we are considered to have borrowed that money from the buyer. So we hold the money, we get to use the money for that period of time, and we transfer the asset a year or more later. Then basically we have to record an interest expense. And we have to imply an interest rate here. So this is a big change from GAAP, because before we didn't do anything with these. We just set up a prepaid account, and then once we transferred the asset, we just transfer it for the transaction price. So the other one is if the customer actually pays us significantly after we deliver the product, then what we have is we're actually loaning money to the buyer, and if we're loaning money to the buyer, then we record interest revenue. So current GAAP allows the financing on the long-term receivable, but not for prepayment. So that's one of the other changes here in relation to the new revenue recognition principle. So let's do an example. Let's do a couple of examples. So here we have a company, Welker Inc., and they receive a $10,000 payment 2 years in advance of delivering a completed product. And they're going to apply a 5% interest rate, and that interest rate usually comes from their experience based on what they may be currently paying, or based on a weighted average of what their debt and their equity rate is. So we're going to prepare journal entries for the receipt of the initial payment at the end of year 1 and at the end of year 2. So the initial payment. So Welker received this $10,000 payment, and they're not going to deliver the completed product for another 2 years. So I debit cash, because we're receiving the $10,000, and we credit, since we haven't provided the product yet, we will credit unearned revenue for $10,000. Now Welker has received this this money, and they're actually using it, so they need to record the cost of using that money. So we're going to record some interest expense here at the end of year 1. So the interest expense is going to be based on that 5% interest rate. So Welker received $10,000, and they the rate of interest that they're using here is 5%. So the first year implicit in the implied interest expense is $500. So the journal entry here, the debit is easy. I'm going to debit interest expense. It's for $500. But the credit's a little bit more tricky, because what we're going to do is we have received cash now for a revenue that we're going to book in the future, and the revenue that we're going to book in the future is actually going to be more than the cash we receive because of this interest expense. So if I debit interest expense, I'm going to offset it in the future by that revenue that I earn. So the credit here is actually, we're going to increase our unearned revenue by the same 500. And so we're going to do that again in year 2. So now I've recognized interest expense in year 1 for the use of the $10,000. In year 2, my interest expense is now based not only on the $10,000 but the other interest expense that I've recorded. So now I take 5% of $10,500. So my interest expense for year 2 is $525. So I'm actually going to, Welker's actually going to transfer this asset and record revenue here. So I'm going to have, let's do these entries separate. So I debit interest expense for $525, and I credit unearned revenue for $525. Then I'm going to transfer the asset. So when I transfer the asset, I'm going to credit revenue, and I'm going to debit unearned revenue. So what's in my unearned revenue account now? What's in my unearned revenue is the $10,000 plus another $500 plus another $525. So unearned revenue account now has $11,025, and so that's how much revenue I'm going to recognize. So notice I received the cash before I delivered the product, and I received it 2 years before. So the cash I receive is less because the difference is the amount of interest expense that I incurred to use that money. So in this case, in a prepayment, I'm going to receive less cash than the amount of revenue that I earn. Okay, so let's go back to another example. Let's use Welker again. Now let's look at a situation where we deliver the product, but then we receive payment 2 years later. So in this case, Welker is going to deliver a product with a value of $10,000. The customer promises to pay, and whether they implicitly promise or they sign a note, it doesn't matter. They're going to pay $11,025 in 2 years. We have 5% interest rate, and we're going to prepare the journal entries again, knowing that we've transferred the asset, but the payment is going to happen in year 2. So this one is similar to what we currently do. Again, we're transferring the asset. So when we transfer the asset, we record a receivable and we credit revenue. So how much do we do? What's the amount of this journal entry? Well, the product has a value of $10,000. So at this point, we're recording revenue of $10,000. So in year 1, since we've transferred the asset but they haven't paid us, they're going to owe us interest. So in this case, Welker is going to record interest revenue. So the interest revenue is going to be equal to the 10,000 times 5%. So the interest revenue for year 1 is $500. So at the end of 2 years, they're going to pay us $11,025, which includes that revenue. So what we're going to do is we're going to increase our receivable by the $500, and we're going to credit interest revenue for the $500. And that represents the fact that they're essentially using our money in this case, and they're paying us for that use. So in year 2, the interest revenue is on not only the $10,000 but the other interest that they owe us, and now they owe us for year 2. They owe us $525. So now our entry to record that is debit accounts receivable for $525 and credit interest revenue for $525. And then they're actually going to pay us, so we debit cash. And how much are they paying us? $11,025, and we credit revenue. Oops, I'm sorry. Oh, delete that. We credit accounts receivable. We already recorded the revenues. Sorry about that. We credit accounts receivable because now accounts receivable has the $10,000, the $500, and the $525. Credit accounts receivable. So now, in this case, the revenue that we record is less than the cash we received. So remember, in the prior case when we had a prepayment, the cash we received was less than the revenue because we had an interest expense. In this case, the revenue is less than the cash because we have interest revenue. Alright, so let's talk about step number, let's talk about the collectibility of the contract price. So like I kind of talked about before, collectability is not an issue with this new revenue recognition principle, so we no longer need to use installment sales or completed contracts. Remember when we talked about installment sales, the reason we use installment sales is because we're not sure that we're going to collect the asset, so we only recognize revenue once the cash is received. So now since we don't have that collectability issue, installment sales is no longer going to be used, as is completed contract, because under percentage of completion, the only reason we would use completed contract is if we weren't able to estimate our progress on the contract. So those two methods of recognizing revenue are no longer going to be used. Now, however, this is the big change. Bad debts, we will still estimate how much bad debts or how much of the accounts receivable will not be collected. We'll still set up an allowance account, but now bad debts is going to be shown as a contra revenue account. It's no longer going to be an operating expense. It will actually be disclosed right below revenue, and it'll be a contra revenue. So that is a big change in what we disclose. All right, and then revenue, again, current GAAP, just to reemphasize, we cannot recognize revenue unless we're reasonably assured that we're going to collect that, and again, not the case in the new revenue recognition principle. All right, then the fourth step, allocate the transaction price to the separate performance obligations if I have separate performance obligations. If I don't have separate performance obligations, then it's not a big deal. But if I do, then really I'm just going to get a relative proportion. I'm going to determine what could I sell each of those separate performance obligations for separately, and allocate the transaction price according to that relative proportion. So here the key is if I have a standalone selling price for these goods or services. If not, there's other ways to do it. I can determine which ones do have a standalone selling price and allocate that price to the related performance obligation, and whatever doesn't have a standalone selling price would have the remaining transaction price allocated to it. Just know that if I have separate performance obligations, that the transaction price has to be allocated in some way. The fifth step then is then now I recognize the revenue. Once I've identified the performance obligation, once I've identified how much of the transaction price is related to each performance obligation, then I recognize revenue as I satisfy those performance obligations. So there's I can either recognize it again, similar to what we talked about before, at a point in time when all the conditions happen, when the buyer transfers assets, cash, whatever, to me, and I perform that obligation, then I recognize revenue at that time. Or I can recognize it over time, for example, in percentage of completion. Or in some cases, recognizing it over time will be related to those loyalty programs that we talked about, the loyalty programs and the miles. The miles will be recognized sometime in the future. So percentage of completion is still used. The key here is that now we're separating revenue recognition based on those performance obligations. All right, so just to give you an idea, this is just a summary of some of the key differences between what the new revenue recognition standard will bring and what we're currently doing in GAAP. The big one for me, or the big one for all of us really, is this collectability issue. We no longer are dependent upon the fact that we can collect the cash or the asset to recognize revenue. We're just more closely relating revenue to those performance obligations. And so one other thing that they addressed is this, along with that collectability, is this variable consideration. If it's dependent upon something in the future, I can recognize that now and not have to wait until those events actually occur. And then the other one is this time value money for prepayments. We did do it for receivables before, and when we talk about receivables after the midterm, we'll come back to this, because now prepayments are going to be associated with an interest expense, whereas receivables are long-term receivables are related to interest revenue. So these are the key changes. Again, you can read through these. I've underlined some of the big ones. This new revenue recognition principle, really, the purpose of it, if you read down the last two bullet points, is there's going to be a lot less industry difference. So this revenue recognition principle is across industries. There's not separate revenue recognition principles for each industry. I think they were getting a lot of industry-specific rules, but now this one is going to be effective, and there's much more disclosure. So, like I stated before, this principle comes into effect at the end of 2016, or essentially the beginning of 2017, and as companies adopt it in 2017, be prepared for a lot more guidance on this, because most of the guidance is going to come as the practical application happens. So that's a pretty high-level review of what the new revenue recognition principle is going to mean to us.